Hello and welcome to Countdown to the Budget, a market special. I'm Lata Venkatesh, with me Surabhi Upadhyay.
Well, Lata, in just about 24 hours from now, Finance Minister will be presenting the Union Budget. What do the markets want to hear from Budget 2017? Well, this is a special show over the next half an hour. We'll be getting you analysis, market views, and of course, the most important points with respect to corporate taxation and the things that the market seems to be a little wary of, Lata.
Oh, absolutely. We will get you what the markets want. But first up, let's get you today's market highlights. The bulls were a bit nervous in trade today. Sensex lost nearly 200 points and Nifty lost over 70 points. The main culprits were IT stocks. They tumbled in trade after fears of visa curbs in the United States. A new bill has been moved in the Senate. Anuj Singhal is here to wrap up the day's markets positioning ahead of the budget. Anuj, how is it positioned?
Well, the markets last day before budget, but the market had bigger issues to worry about than the budget itself. Global cues really spooked markets, especially what's happening in the US with the H-1B visa bill, also what could happen with the pharma stocks or pharma companies. So the market had some issues to deal with, and the market has had a rally. So there was always a case of some profit taking ahead of budget. So today it was a combination of that. In fact, it was the Bank Nifty and ITC which kept the bulls in the game. Otherwise, things could have turned ugly. Let's start with stocks of the day. Idea clearly was once again a stock of the day. Grasim and Bharti Infratel were the other stocks. Grasim was down about 5% and Bharti Infratel, second day running, down 10%. But the sector of the day was IT. Big derating in big names. TCS, HCL Tech, Infosys, Tech Mahindra, all of them were down. And even pharma stocks were lower today. Sun Pharma, Aurobindo and Lupin were all losers. Other nifty losers included stocks like GAIL, Adani Ports and Tata Motors. While there were some big F&O losers today, Cadila Healthcare posted its numbers, Adani Enterprises, Just Dial, Dish TV, KPIT Tech, M&M Finance. So suffice to say that ahead of budget, there was a bit of profit taking, but there were global factors as well which were responsible. Let's see what budget brings about tomorrow, because this looks like a global leg of correction. So in that sense, regardless of what happens with budget, post-budget, global factors will again take over.
Oh yes, markets precariously and a little cautiously poised, but some optimism over the last few days. Let's hear out some top market experts on what they expect from Budget 2017.
I would look at the headline fiscal deficit target. I would look at what the government is spending through extra budgetary resources. And I would also look at the revenue numbers the government assumes, given that there is some hope in the government for tax buoyancy.
Crucial thing about this budget is that it has to live up to previous promises of the Prime Minister in terms of reform, but reform within the rule of law, so that I think it's just a perception and a wrong perception that somehow the government of India is capricious, acting outside the rule of law. It isn't, but it would be really wonderful if the budget could confirm that and make it clear to everybody that India is not following the route of some other emerging markets.
Well, that's what market experts are saying. But the big fear on Dalal Street ahead of the budget is more about taxation. Well, first, Surabhi, since you've studied these taxes very closely, what are the big expectations and big fears?
Well, first, let's start with the optimistic or the hopeful news, which is, of course, a reduction in the corporate tax rate or the MAT rate as well, as people have been talking about. So any reduction in those rates, overall sentiment positive, would be taken very well by Dalal Street. But now let's start talking nitty-gritties. The one word or the one tax that everybody is talking about is the dividend distribution tax. The effective tax of DDT right now is just a little over 20%. And there has been a lot of tax talk in the circles that perhaps the nature in which this tax is levied, the manner in which it's levied, that could be changed. Right now, the tax is levied at the company level. Perhaps this budget could bring about certain changes and start levying this tax at the individual level. Remember, last year, those who are getting hefty dividends, those who are earning over 10 lakh rupees in terms of dividend income in a year, they were to pay additional 10% tax. So will the finance minister start changing some of these taxation rules around or not? That's something the market is watching out for. And then very quickly, indirect transfers. This became a big word in the run-up to the budget for the market, because the circular that came out from the CBDT initially said that investors who are investing money into India-dedicated offshore funds, they will be subject to taxation. Of course, huge hue and cry by the industry, and subsequently this circular was put in abeyance. Now, the market is hoping the finance minister makes a formal statement saying that this would be completely withdrawn, but basically some formal clarity on this is awaited. But perhaps the biggest of them all is LTCG, this four-letter word that's got everybody at the edge of their seats, long-term capital gains. Will the definition be changed? What will happen? Retrospective, prospective? Well, let's get in Nimesh with the details on this one. Nimesh?
Well, from the equity markets point of view, the big thing to watch on the budget speech would be whether there is a change in definition of long-term capital gain tax from 1 year to 2 years. So, and that's something which has been perceived by the market that it's likely to come. In that case, you will see a knee-jerk reaction for sure. But there are a few scenarios to watch out for. First, and the best case scenario is that the FM says that the new law of long-term capital gain tax to 2 years is applicable only after 1st April 2017. That means all the previous investments will not be touched, and only after 1st April, if someone buys fresh equity, there will be a 2-year lock-in period to avail the long-term tax benefit. That is the best case scenario. In that case, you will see a knee-jerk reaction, but markets will quickly stabilize once that announcement comes. The second scenario is there is a cutoff date to calculate the short-term and the long-term capital gain tax. Remember, short-term, if anybody books within that 1 year, they has to pay 15% tax. But for investors who fall into that 1 to 2 year category because of the change in the game, you will see that there is a cutoff date at which the short-term and long-term is calculated. In that scenario, you will see a sell-off, knee-jerk sell-off in the markets tomorrow. But after that, probably in a week's time, markets will stabilize as and when people realize as to how to adjust the books in the short-term and long-term. So that's the second scenario to watch out for. The third scenario and the worst-case scenario could be if there is a retrospective effect to this long-term capital gain tax from 1 to 2 years. That would be the worst case for the markets, and you'll see a sharp dip in the markets tomorrow. The other thing to watch out would be if there is a change in definition of the short-term capital gain tax as well. There is a buzz doing the rounds that maybe the government will say that any short-term income will be now considered as a business income, and the tax would be 30% and not 15%. In that case, you will see a very sharp sell-off in the markets tomorrow, because that will be perceived extremely negative by the markets, at least in the near term. So from a long-term point of view, there are a couple of scenarios which I spoke about. But in the short term, for the short-term capital gain tax, if it's classified as a business income, you will see a sharp sell-off. So these are the broad things to watch out for. But as I said earlier, from the previous examples, the best case scenario looks like the FM says that the long-term is increased from 1 to 2 years, but it will be effective from 1st April 2017. That, to my mind, is the best case scenario for the equity markets. But looks like one will have to base for some sort of volatility, given that there is a lot of expectations now building up that there is going to be a change in definition of long-term from 1 year to 2 years. Back to you.
Oh, that's comprehensive, Nimesh. The markets will keep its fingers crossed on all those expectations. As Nimesh said, markets are waiting with bated breath to see what the finance minister will deliver. Earlier this month, we spoke to top market experts at the Bombay Stock Exchange on their budget expectations. The bottom line from this band of experts is no bad news will be good news for Dalal Street as far as taxes are concerned.
If you get a tax increase in markets, there will be a short-term reaction. But I think it sort of remains to be seen as to how deep it will be, because market usually will adjust one time for this kind of event. It will not be something it will hang on for a long time, and you cannot see that in sort of isolation alone. For example, if you're going to 25% tax rate, let's say on corporates over a period of time, that is a 5% boost in earnings effectively. So if the tax rationalization is, the entire is part of a gamut of things which makes sense to the market, then I don't think you might see that kind of reaction. Also remember that long-term probably is also equally important in terms of tax rates, because effectively by taking out Mauritius Treaty and Singapore Treaty, you essentially have introduced much larger portion of participants in the markets are paying a much larger short-term capital gains, no impact on the market. So the fact is that a bunch of FIIs who are paying no taxes so far are starting to pay taxes, has had no impact on the market. I think a small percentage increase might not sort of alone cause the market to derail.
Okay, 15 to 20 will not disrupt the market. But before I come to Sudhir for more complex questions, Navneet, what if short term is not 1 year but 2 years?
I think if you have a year where economy is growing at 9%, corporate profitability is growing at 15%, markets are doing well, global investors are putting money, domestic investors are quite enthused, that could be a good environment to do that. I think given that in next couple of years, huge amount of divestment needs to happen. And if the market sentiments are not good, global investors, I mean, maybe till couple of months back, we were the only oasis of hope for the world. But today, you look around the world, US markets are doing well, UK is doing well despite Brexit. I think this year European equities could do well despite all the political challenges. Some of the other commodity producing countries are doing well. So I think we have to face that competition for the global flows also. So maybe I think it can wait for some more time.
What is the most likely alteration or tweaking you expect on the corporate front?
So I think two quick points, Lata. I think I agree that if you increase the threshold limit significantly, it's counterintuitive to your objective of increasing the tax base. Instead, why not, for example, think of a 5% tax rate at the lower levels of income, which takes care of the massaging point, but it also serves to incentivize a particular category of taxpayers, particularly self-employed.
Do you expect it?
I think so. I think it can be a more realistic expectation than, for example, our own survey at EY, the response was that a majority thought the exemption limit should go up to 5 lakhs, which I think is far more challenging for the government. But a 5% rate is far more realistic at lower levels of income, as an example. So I think that's one point. The other point is about, the corporate, which you rightly mentioned. I personally feel this is the budget when you will actually find a statement articulating the rate of corporate tax for this year as well as the next year.
If the corporate tax timetable, as he says, doesn't come, is it a deal breaker for markets?
I think the expectations are that something will be done this year.
All right, time now for us to take a quick break. But on the other side, highlights from the economic survey as well as what the fiscal math could look like in Budget 2017. We'll be back in a moment.